I am Danielle Anderson here with Waterstone Mortgage. Thank you for joining us today for tax benefits of investment properties. I'm excited to learn from Michael Coe with Saltmarsh, Cleveland, and Gund, all of these strategies that we have available to us as property owners of investment properties or second homes. Again, I'm Danielle Anderson. I'm a loan officer out of Colorado. I'm also a short-term rental host as well as a long-term landlord. And Sue Botello, my amazing coworker out of Florida and Alabama, we got together a month ago or so, and we were chatting, and there was a lot that we didn't know even after being property managers for multiple years on tax deductions as we were doing our April taxes. And so that's kind of where this call and this topic came from. Sue has multiple investment properties herself, and she's an awesome LO and a resource for her clients and realtor partners in Florida. So before we get started with taxes, one of the questions that I'm getting all the time from my clients and my real estate partners is now still a good time to invest? If you're investing in a investment property or a second home or even buying a new home, people are like, oh, there's talk about a recession, their interest rates are higher than we've seen in the last 3 years. Is now still a good time to invest? So I just want to cover some of the basics of where we're at and what we're seeing in the economy and real estate right now. So we're still in a very tight supply market where, yes, we've gotten a little bit more inventory, and that's wonderful. One of my coworkers analogies is like, before we were shopping on Black Friday, where you pretty much had to like wait at the door at Target, and now we're shopping at Target on a Tuesday with a latte and kind of like go through the aisles. So I thought that was a great analogy, where the average, to be at what's called a balanced market, you need 6 months of inventory. Across the nation, we're currently sitting at 7 days of inventory. So just a little over a week of inventory. So we're still in an extreme seller's market, even though that's relaxed from 4 days of inventory. And I'm so sorry, that is Denver numbers, not nationally. So 7 days of inventory in Denver, but nationally, Sue, do you know what that number is nationally? I think it's 2 weeks inventory nationally.
Days, yeah.
So whether it's Denver or nationally, we're still in a very seller's market because of inventory. A part of that is because of an underbuilt. We didn't have enough people building homes from 2008 to 2022, and then the average age of a first-time home buyer is 34. So they're taking inventory away from the market and not replenishing it. So what that means is that there's still going to be continued price growth on homes. Now, we're probably not going to see the 15% to 20% appreciation in price growth going forward in 2022 and 2023, but we're going to see it relax and kind of level off and maybe get back to that 3% price appreciation growth. So I just wanted to run through some numbers. We use something called Bridge Builders, and it just provides an aggregated information on what's happening. So one of the other items in the market is that a recession doesn't equal a housing crisis. Me being 34, the only recession that I really took part in is 2008. And that's where our heads go. And 2008 was caused by predatory lending and just different market environment than we have today. There was a ton of supply of inventory, and people in 550 credit scores with no income docs could still buy a house. So it's a little bit different from where we're sitting at. Over 50% of people that own homes have over 50% of equity in their house. So if they were in a tough financial situation, they don't need to go into foreclosure. They can simply just list it on the market at open value pricing and get what the home is worth. So that's what the biggest decline when we went into a recession at the 19.7%. Our current market is completely different than the market in 2008. And so that's just, so just because there's talk of going on a recession, which is the definition of 2 consecutive quarters of declining GDP, doesn't necessarily mean that home prices are going to fall. This is just a quick note from home price appreciation since World War II in 1945 to today. So if you're buying to hold, historically, price growth always goes up. Obviously, the other thing that you're going to look at if you're buying an investment property is just cash flow. Is it cash flowing? Does it make sense right now, even at a rate of maybe 6.25 or in the 7s? Are you still being able to cover that mortgage and make money? That's also, weighing into your decision. And then this is just a quick graph of the lending standards and why 2008 was a little bit different, or a lot different, than the market that we're sitting in today. If you're looking at accumulated appreciation, this is the forecast for 2022 through 2026 of 9 different economists on what they're thinking price appreciation is going to be across the country. So 9% in 2022, and then kind of leveling out into through 2026. And this kind of breaks it down between optimists, all panelists, and pessimists. So 2026, even from a pessimistic view from economists, they're still looking at a 10% price appreciation growth. So I'm going to throw that over now that we kind of have a generalized idea of what the environment that we're in currently from our real estate nationally, to Sue Botello, who's going to introduce our guest speaker, Michael Coe, to dive into the benefits of owning investment properties from the tax side.
Hi, I'm Sue Botello. I'm with Waterstone here in Florida. We have a little bit of a different market than Danielle does out there in Colorado. First off, Michael, you're going to have to unmute yourself. I can see you're still muted when you get to talking. Michael Cole, let me back up a little bit. When we started talking about this, we were like, we need to get an accountant, because Danielle and I both, like she said, we own investment properties, and trying to see what we could deduct ourselves. We knew there was some stuff that we were missing, that a lot of stuff apparently that we were missing. And then we started talking about, our realtors, our clients could all benefit from learning from an accountant as far as what they could actually do. So we got with Saltmarsh, Cleveland and Gund. They got us hooked up with Michael. And Michael is an accountant and an attorney and a doctor. He has a Juris Doctorate from, I think it's Seton Hall, is that right? I'm not looking at that. But he is a director in their tax and accounting services practice of Saltmarsh, Cleveland. And he's got over 15 years of public accounting experience. He's written some things. He knows more stuff about accounting than probably any of us will ever need to know, because that's why we hire Saltmarsh, Cleveland and Gund, is to do all of this for us. But Michael also owns, I think, an investment condo. So all of the stuff that he's going to teach us today is stuff that he's using personally as well. So we know it's legal and good, because he's an attorney and an accountant. So we know the IRS will be okay with what he tells us today. So welcome, Michael, and thank you so much for doing this for us.
Thanks, Sue. I'm really happy to be here and glad that we can have what I'm hoping is going to be a great conversation.
All right, sounds good. Danielle? First off, on the mortgage side, there is a mortgage difference between a second home and investment property. Understand, when you or your client buys a house as a second home, the IRS doesn't come to us and say, hey, how did they buy it? That's what it has to be. But when we do a mortgage, and people don't own a property within 50 miles, they aren't going to use rental income to qualify, and they're going to use that property personally for at least 15 days a year, we can actually consider that a second home. However, for tax purposes, there is a difference. So Michael, can you kind of tell us what the difference is between a second home and an investment tax side?
Yeah, the great way to think about it is that when you own a second home that's just for your personal use, you lose a lot of the deductions. So you're capped at basically what's about $1.1 to $1.3 million of principal mortgage balance for your interest deductions on your personal return. But what's really nice is that if you own an investment property, everything from 100% of the interest to your your use of toilet paper, if it's a short-term rental, whatever it is that you incur, your tax return preparation fees, all of that magically becomes deductible on your tax return. And that's really a great way of thinking about an investment property from an investment standpoint. Is it's not just about the level of value of an appreciation that you're going to get year over year as the economy grows that Danielle was just talking us through, but it's also about the cash flow savings you're going to have from being able to offset maybe some cash flow income with deductions from your return, deductions from these properties. And that's really what's really great about it. And I know that the next line kind of discusses a short-term rental versus a long-term rental. And that's also really important, because if you're constantly renting out your house, like through an Airbnb or Vrbo, and I actually rented out a Vrbo house in Baltimore for 6 months when I was reassigned there. Those short-term rentals being less than 1 week at a time, if you can string them back to back, that actually will get you active income, which means your deductions don't just go against your other, real estate investment income and cash flow. It'll actually go against, say, a W-2 income, which is really, really awesome and a great way to think about ways to manage your tax expectations each year. The problem comes oftentimes is that a lot of people say they're going to do this, but then they don't ever actually rent their house enough to meet these categories. And so it's always really an interesting discussion when clients come in talking about their investment properties.
And what is considered enough to be able to do this when you said they don't rent it enough?
So typically, if you rent it for more than 15 days a year, you're going to get some type of a deduction. The question is how big of a deduction, right? Okay. And there's often this multi-layer standard, but it's got to be available for rent and actively being sought for rent. So there are investment properties. For example, I also own a plot of land that we actually rent to a solar farm. And we were trying to rent it for almost a year before we actually got somebody to come in and rent the land use from us. But during that time, I was still able to take all of my deductions because we were actively promoting it. We had a realtor using it. We had it listed on a few different websites for available for use for different purposes. And we were able to support that deduction. However, my neighbor owns a plot of land that he mostly goes hunting on. It's kind of hard to really say that that's really available for use because he doesn't actually encourage anybody to go rent it. He doesn't have it listed anywhere, and he doesn't actually use a realtor or any other professional to really try and seek somebody to come in and provide cash flow for him for the use of the property.
Gotcha. And then what is a part use vacation rental, and what does that mean in regards to taxes?
Yeah, so that's a great question. So a part use vacation really kind of relates to when you have a rental that's being used for less than 15 days a year. And that can cause some interesting changes to the way that it impacts your taxes. So if it's a part use vacation rental, then it means that you're using it as a vacation house yourself.
You went mute again, Mike.
So when you're using a part use vacation rental, that's when you're using it for 215. For 15 days or less as an active vacation rental. And again, that means that it goes off your Schedule E and becomes a personal deduction. So those great discussions about mortgage interest deductions, the ability to deduct improvements that you make to the property in year one, things of that nature, those all go away because you no longer have the capability of doing that.
Gotcha. All right. Next slide, I guess, Daniel. All right, and this is the big one. This is the whole reason we created this right here. What are some common deductions that are missed by investors? And I can tell you this, when we did our preliminary meeting on this, on having this class, we learned some things. I know I did. I'm sure Danielle did as well, as far as what we could deduct that we didn't even know. So Mike, if you want to go into that, that would be great.
Yeah, so honestly, we're going to talk about it a little bit later. But one of the big things is that just documentation. Oftentimes you would be surprised how many times you end up running to, Home Depot or whatever it is to pick up, a new faucet or whatever it might be, or a new doorknob, or, you need to swap keys out because swap doorknobs out because you have a different renter coming into a building, right? And so you don't want to use the same set of keys for somebody new coming into your facility. Oftentimes, I'll just run out to the store, and that's one of those things that if you're not actively keeping track of the expenses you're incurring, that can cause some issues. But honestly, the biggest one that I see people miss is depreciation. And so what depreciation means is if you take the value of your house, you would subtract out the cost of the land, and then you can depreciate that if you're using it as a rental, an active rental. Oftentimes, for personal use, it's going to be 39.5. For business use, it's going to be 27.5 years of depreciation. But what's also can be depreciated is, let's say you go and you buy a new refrigerator, you put in new countertops, maybe you provide a furnished house, like a short-term rental, where, you've got beds and couches and things of that nature. All those can either be written off or depreciated over time. And it's really important to identify and keep your receipts when you're doing that, And for each piece of property you buy that goes into that building, you get to take those deductions. The other side is like I've got a home office that I use for my rental properties and for my business use. I get to deduct in my personal home part of my depreciation of my house equal to the square footage that I have actually being used as my home office, and that doesn't have any other kind of uses within my business, my family life. And so that's really, really important. Another thing that's really interesting is travel. So a lot of people think that when they're going into an investment property, you know, they might go to a different county or drive to a different state or take an airplane to go look at investment properties, especially if it's a vacation like investment property. And what they forget is that those costs of travel either can be capitalized, meaning it's going to reduce your gain on the back end because you get depreciation, or it can be immediately expensed on the front end. And so a lot of times those travel costs to go buy an investment can be written off right away. And that's really something that can be great if you're a multi-property investor, like you are, Sue. I know that you've got, I think it's 5 properties, you know, because you're actively using your properties. Even if you don't buy a new property, you can take a deduction for the expenses incurred to go look at a new property that you might want to invest in.
I might go look at it one day since I've never been to 2 of them. So let me get this straight. So if I live in Florida and I fly to, or let me do it backwards. If I live in Colorado and I fly to Florida, even though I'm coming on vacation as well, if I spend time and go look at real estate, I can write part of that off and I buy an investment property?
Yes, and that's where you really need to work with your tax professional, because it depends on how much time you're spending, how you're doing it, and how well you document it. Again, it goes back to that bookkeeping being really important. I'll give you an example. I was looking at a new property to invest in New Jersey, and I flew out to New Jersey, and I was there for 3 days looking at houses and condos, and 2 days I was there for personal use. So I was able to document the fact that I met with 6 different realtors. I met with a mortgage company, I reviewed properties, and I rented the car with the mileage, and I documented all that to show that I was actively going and looking at investment properties in a specific area. It's not as easy as, oh, you know, I went and I took the, you know, Disney tour for a timeshare, and now I can say that was my investment, right? That's not an active use of a whole day for really focusing in on developing an investment property.
Okay. What about if I live in Colorado and I have to come to Florida because I own an investment property here and I need to fix something in it? Can I write that off as well?
You can, but again, there are certain limitations, right? Where if you fly in to change a doorknob, that's not necessarily going to be a really supportable type of transaction. But if you're flying in because, you know, you had a water main break and you need to go through and rip up all the carpet and you're doing part of kind of the rehab yourself and you're here for several days, that's a lot easier to kind of go through. Okay. It's also easier if, you know, Florida is notorious for its bad hurricanes. If you fly there to assess damage and review what's going on with the tenants, those also can be deductible expenses.
Okay. And then you talk about the mortgage interest payments can be deducted, HOA fees.
Absolutely. HOA fees are 100% deductible if it's being used as a rental property. Mortgage interest payments become deductible as a business expense. Heck, even if you take somebody out to lunch, you take your attorney out to lunch, those can be deductible meals and entertainment expenses as a part of your investment business, if the attorney you're taking out is the one that works on your investment properties. Okay. So it really can be, it really opens up when you have an investment property, the types of things you can deduct as long as it relates to that work.
You mentioned that not having great bookkeeping records can spell disaster. And we are going to ask the question, what should you always keep records of? But I think we're getting ready to get into that. I think, is that the next frame, maybe, Danielle? Oh, no, before we get there, we're going to talk about rehab. Let's say you buy a property, a distressed property, and you want to completely gut it and rehab it, or you just want to remodel a bathroom. What type of things can you write off, and how do those change next year?
So typically what you want to do is you want to look at how much work you're doing. I'll give you an example. Let's say you bought a property that was damaged in a hurricane and you needed to replace all of the sheetrock, all of the, you know, painting, some exterior work, things of that nature. The parts that go to what I'll refer to as the core structure of the building, the windows, the siding, oftentimes the sheetrock, things of that nature, plumbing, are going to be capitalized in, meaning it's going to become a part of your basis for depreciation that we were talking about earlier, that you can either deduct over time or to offset your gain when you sell the property. But things like carpet, painting, new light fixtures, almost all of that can actually be deducted or depreciated over 1 year under the current regime that we have. However, it does change once you get to 2023. A lot of those instantaneous deductions for items less than $5,000 go away starting in 2023. So it's really important that you keep your eye on the current kind of climate in Washington, because those deductions go from being 100% write-off this year to being an 80% write-off next year to 60 to 30 and so on and so forth down over a few year period of time. But yeah, if you're doing a rehab, it either can be depreciated, written off, or be used to offset your gain on the back end.
All right.
Stu, do you mind if I jump in and just ask a follow-up question on that? So if they go away in 2023, and a lot of participants on the call, and myself and Sue included, have certain rehabs that we need to get done, do you encourage us to kind of hurry up and do those before December of 20? Like, is that regulation as of 2023 new year, and 2022 we could still take deductions?
Yeah, again, I think that's where it goes back to doing what you think is more appropriate in Washington. Because if you're gonna, everybody's tax situation is limited. Some people are limited on the amount of the deductions they can take. Some people aren't. If you're a realtor, oftentimes you're not going to be limited on the deductions you can take. And if the tax rate, the tax bracket you're going to be in increases next year, which is kind of the current thinking of most accountants and lawyers that I know, it actually might be more beneficial to take that deduction next year and get everything all set up, because now you're going to be able to offset income that's going to be taxed at a higher rate. Think about it this way. If you get a 100% deduction today, is that worth a 90% deduction tomorrow? But, instead of it being worth 30 cents on the dollar, it's now worth 50 cents on the dollar because your tax bracket went up, right? So oftentimes I personally try and align when I'm going to do big projects for deductions such as a rehab with when I'm selling one of my other investment properties. So that way the gain is kind of offset by some of my other expenses and I can kind of smash things together. So again, it's more about personal planning on that side, and when cash flow works for you, right? If you've got the money to do it now, I always say that it's better to invest when you can than hold off.
Gotcha. Okay.
Hey, Michael, on the rehab side of things, if you're in need of, let's say, for example, a vehicle like a truck, because you're gonna have to be transporting all these goods into this new property that you're gonna be putting in, and you're not an LLC with the property, is there any deductions for that, for a vehicle purchase, for the participation of the rehab without an LLC, or do you have to create an LLC?
You don't have to have an LLC. And oftentimes, if you're using a truck for both personal and business use, that's where it kind of goes back to that mileage discussion. So a lot of realtor friends I have, they own a separate car, like a small car that they use to go drive around to look at real estate properties because it's just more efficient for them. And they're able to depreciate that vehicle because it's being just used as a part of their real estate activity. But let's say me, I don't use a vehicle only for my real estate activity. I've got a truck that I, haul things in all the time, and I also use it for my personal use. There's oftentimes you can get about 79 cents per mile for each mile you drive that vehicle as a deduction for on your tax return. And what's nice about that mile deduction is then you don't need to keep gas receipts and some of the other activities that kind of go along with car maintenance. You just get a straight 79 cents per mile. And as long as you document it well with either, I use the QuickBook app. I know that, I think you mentioned Notability is one that you use. Heck, I've got clients that just use a notepad and keep good records on the notepad of when they drive to the store. That can be enough to qualify you for the deduction. The key here is documentation. That goes back to that bookkeeping. The IRS will 100% reject a deduction for mileage in a review if you don't have a support like a notepad or documentation or photos or whatever it might be of what you are doing. But they will if you have any sort of documentation. It's actually a fairly loose documentation standard. So again, here, it just goes back to write down everything, because the more you write down, the more you remember to deduct.
Good question. Thank you, Brent. So let's go into the bookkeeping side of it, because we were talking, myself, I have a real estate agent in Alabama on 2 of my properties, and she'll send me a text, hey, Venmo me X amount of dollars because I just did this, and I don't have receipts for it. So I myself am not very organized. I think, Danielle, you said you're probably not as organized as you should be either. So Mike, if you could go into a little bit about how the bookkeeping would help us and when we need to get a bookkeeper. I mean, if we have one property and it's a long-term rental and we don't really have to do a whole lot versus if we have more than one property, or even if we suck at keeping records and we have one property, at what point do you suggest that clients should get somebody to help them with the bookkeeping side of it?
Yeah, the flat answer is always, if you are not somebody who's good about remembering to, save your receipts and do things of that nature, having the bookkeeper that you have, monthly call or a quarterly call with, whatever it might be, oftentimes keeps you honest because you're more likely to remember things that you've done recently. So just having that bookkeeper can help save you money because you're going to be able to both deduct the expense of the bookkeeper, and you're going to be able to remember a lot more of those things that you do during the course of your year to be able to take deductions on. Another part of the bookkeeping kind of equation is, what's the cost of a bookkeeper, right? To your point, if you only have one property and it's roughly cash flow neutral, you're kind of the rent you have because it's a newly purchased investment, maybe you're only making 3% a month or 5% a month, whatever it might be, against all of your accrued expenses that you have between preparing the tax return and paying taxes and handling trash payments if you're providing that as a service. Those types of things oftentimes can influence whether or not taking the bookkeeper is really important to you, because it just might fiscally be worth it. However, I myself, I use a bookkeeper for my 2 investment properties, and it's not super expensive for me because they charge by the hour most of the time. We here at Saltmarsh charge by the hour, and oftentimes you're only doing an hour a month or an hour every couple months just to check on cash flows, check the bank receipts, and mark down the expenses.
Okay. Dana.
And that also raises the other question that's kind of on here, which is, when is it good to open up a bank account? And I will tell you, I open up a bank account for every investment property, and I tell everybody I work with to open up a bank account for every investment property. Having a bank account for each property makes it really easy to delineate when cash is coming in and when cash is going out. I personally have my bank set up where I can transfer between my accounts just using my phone. So what's really nice for me is that my bookkeeper has access to review my statements, but not to change any of the money in my account. And so whenever I need to pay an expense through Venmo or charge it to a credit card or whatever it might be, I just use those bank accounts to make the payment. So that way, then my bookkeeper knows that there was an expense that was incurred, and they make sure that they can keep the records. And that oftentimes simplifies the bookkeeping activity as well as the investing activity. Because when you go to sell, 15 years down the line or 5 years down the line, you'll be able to go back through your cash receipts and make sure that you have the exact right amount on your basis. Those little expenses, for new doorknobs or replacing a washer dryer or, putting a new faucet, those sub $500 expenses, although a washer dryer is not sub $500, those things that sometimes you just do because it's easier for just order and take care of it. When you go to sell your property, those can really add up to thousands of dollars. If you have a property for 10 years, and you have $700 a year, you're talking about $7,000. So when you go to sell the property, you're talking about $3,000 to $7,000 in savings that you're going to get from offsetting your gain on the cash, which is really great, and it's a nice tax savings.
All right.
Can you go into that a little bit more, Mike, on what that looks like when you go and sell it, and what you need to be thinking about as an investor on, does this make sense to sell? How do I even know my tax liability when I'm selling it? Just kind of shed some light on what we need to be thinking about.
Yeah, this is oftentimes where people that invest as kind of either on the side or, are just kind of really getting into the investing side. It really kind of comes in handy to have a good accountant or a good bookkeeper that you use, because they actually keep track of that. Like, we do the basis calculation for all of our clients every year for all of their properties that they have. So we can basically tell you what your gain or loss is going to be. And when I say basis, I do apologize. That's kind of a term of art within the tax world. So let's just take a step back. What you pay for your house, including closing costs, is your basis in the house and in the land. As you incur expenses such as depreciation, your basis goes down. And as you make major repairs like rehabbing a bathroom, your basis goes up because you're putting money into the property. The higher your basis is, the more you can depreciate or write off. And also the higher your basis is for figuring out your gain or loss. So a lot of people are used to selling their personal home where there's a $500,000 exemption, where when you sell your house, you don't recognize gain or loss. That's a statute under the law. However, when you sell an investment property, there's no such exemption. If you bought the house for $100,000 and you sell it for $200,000, there's a $100,000 gain that could be recognized at 35% or at 20% or 15%. And so having your basis and understanding, is that $100,000 really $100,000? Oh, but I rehabbed the bathroom for $10,000 and I had a water main break one year and I had to put in another $15,000 into plumbing. All of a sudden I'm at 125. And so my gain is now only $75,000 when I sell that $100,000 house for $200,000, because I have $25,000 in additional expenses that I've incurred over time. And so my tax liability, assuming, we'll say a 20% rate, just dropped by $5,000. So I made an extra $5,000 in my pocket because I kept good records about the stuff I spent on my house.
Interesting. And I have a follow-up question to that, Mike. If that tax basis is based on your normal tax bracket. So a strategy could be for a retired individual or soon to be retired. They're not retired yet. Let's just say they're making $200,000 at their W-2 job. Then they retire and they're just drawing on Social Security. So their tax bracket changes. It might be better for them to wait to sell their investment property after they've reached retirement, because then their tax bracket goes down. Would that be something that they could consider?
So that's one of those facts and circumstances. And I hate being the accountant that says it depends, right? So oftentimes it depends how long you've held that investment property. Have you been depreciating it? What type of property it is. If it's something that you've had for many, many years and you've depreciated that down very substantially, that there could be a benefit to that. But in most cases, you're going to be capped at around a 20% on the capital gain, as well as what's referred to as depreciation recapture on the gain on the sale of your house or on the sale of your investment property. So you really kind of need to get into, was it ever a personal use? Is it a mixed use? Things of that nature. One of the things I like to tell people is if you have a house that you've been depreciating for years and you're going to sell it and you're thinking about living there for a few years, if you can live there for 2 or 3 years without upsetting life before you sell it, oftentimes we can get you into that personal residence exclusion and avoid picking up almost all of your gain on the sale of your property. So that's also a nice thing to remember too, is if you have flexibility in where you live, sometimes if you're thinking about selling in a couple of years out of a property, if you can, you want to move into that property and live there and rent out your other home, because that really gives you some great flexibility in where we can play with the tax code, if you will.
And I'm going to assume most people know this, but there's also a way, obviously, to defer those capital gain taxes you're having to pay and do a 1031 if you're going to buy a subsequent investment property.
Yes, and actually my favorite 1031s are when you sell a house and buy a yacht. I do that for clients all the time, and it's something you don't think about. Yachts can technically be homes if they have a place that we can cook and a place to sleep and a bathroom. That qualifies as a residence in most states. And so there are a number of people that I know that actually 1031 into a yacht or a large boat that they can use. In fact, I just did one for a client, and this is obviously an outlier. He sold a $4 million house and bought a $6.5 million boat and 1031'd into it that he's planning on renting out as a luxury cruiser around kind of the Tampa area. So it really kind of depends on what you're doing. But when you think about 1031s and you think about how you're going to exchange things, don't forget to think about, even if you're somebody who has a house on the water and you have a slip that you let people kind of put their boat in and out of, or they can park their boat there for the summer, whatever it is. We have a lot of snowbirds in Florida that like to leave their boats places. Oftentimes, you can actually depreciate and expense your own personal use of kind of that facility by renting out the other side of your dock to somebody else. And so as we talk about homes and we talk about deductions, remember a home isn't just a building. There are a lot of different facilities that can qualify as a home, and you don't have to rent out your entire house. You can rent out just part of it and still get some of these benefits.
Okay. We do have a question. Okay, I'm sorry, Brent. I was going to ask this question that Heidi Morgan just asked a question that says, if I'm in Florida, if I move from my primary residence to another place and then rent the old primary, would I lose the 250,000 single deduction if I sell it later? And I know the answer, but I want you to say that, Mike.
It depends on when you sell it. If you sell it within, I believe it's 12 to 18 months, you should be okay. If you sell it after 2 years, definitely no.
Brent, you had a question?
As a mixed use in that same category of selling or bookkeeping, well, let's start with bookkeeping side of things. As a mixed use property like I have for myself, do I need to keep all expenses separate from the property because it's only one tax entity, but I use 2 different listings through a management company for the same technically property? But
hey, Brent, why don't you tell people how your property is set up?
Right.
Because they might not be as familiar with kind of how you operate, as you know.
Okay, so here in Florida, I have a home that was created as a main house, and they added a pool house to the back of it. At one point in time, it had a pass-through door. I took it out in my remodel, and it's a complete accessory separate from the main. It's attached to the main house with no access. So I have 2 separate listings, one as a guest house, one as a main house through Evolve is the company I use. And I bounce back and forth between the 2 units depending on which one's rented.
Yeah, so that's a great example of how these things get complicated very quickly, right? So oftentimes what you'll see is somebody buys a duplex and they live in one side and rent out the other side, and it becomes very easy to have that delineation. For you, because you're doing short-term rentals for the most part, and you're kind of flip-flopping back and forth, it really becomes about number of days used on each side for personal use, and kind of how much it's actually available. What's nice for you is that always one side of it is available for deduction, so you're always going to be able to deduct pretty much half of all of your expenses, right? Half of your interest, half of your insurance proceeds, things of that nature. But on the other side, getting that depreciation deduction, being able to separate out, was that toilet paper you bought for you or was that toilet paper you bought for the short-term rental? That's where that gray area starts to kind of really get to be a little bit fuzzy. And you need to work with your accountant professional to really identify and document how they get comfortable treating those expenses.
So Michael, are you taking on new clients?
Always.
Perfect.
So what you're talking about right there works kind of like, we were talking earlier, our area, there's a lot of properties here that have carriage houses. So it kind of works the same way. If you own a property with a carriage house and you rent out both of them separately, and then sometimes you come and stay in one or the other, you're probably really going to need Mike or somebody at Saltmarsh Cleveland to help you out with that one, just to let you know.
And what's the benefit for me, Michael, to live in a smaller portion of the house or the bigger portion of the house for tax purposes, deduction purposes, and then future sale if I'm ever looking to do that?
So that's where it gets interesting. The future sale, it's probably better to live in the larger portion of the house because then you're going to be able to kind of avoid, it was mentioned the 250 exclusion for the sale of a personal residence when you stay there for 2 of 3 years. You can then kind of exclude a larger portion of it. At the same time, if you're worried about it from a cash flow perspective on a year-over-year basis, staying in the smaller portion will allow you to take a larger percentage of your deductions. While not a hard and fast rule, there are different revenue procedures and revenue rulings and court cases that basically look at it on a square footage size, right? So if you've got 200 on one side and 100 on the other, it's a 2/3 versus 1/3 deduction review. And that's really kind of where it gets interesting. Is it worth it to get the 2/3 of the deduction now if I'm planning on selling it in 3 years because, I know I can avoid a larger portion of that appreciation in value? Or is it worth it to kind of hold on to it for 10 years and take the larger portion of the deductions, 2/3 deductions, actively every single year? And that's where a good accountant, a good financial analyst, things of that nature really can shine because they can do projections for you.
Thank you for that.
All right, so here's our next one. If I'm making too much money on my investment or second home, and God, isn't that a great problem to have sometimes, What type of expenses should I consider investing in at the end of the year? Basically, what we're looking for is somebody who's going to have to claim too much rental income even after they deduct their expenses. So what are some tricks you can give us to minimize that liability?
So I actually hit this problem myself because I'm a passive investor. And I mentioned I have a condo in New Jersey that we rent out. And that is actually cash flow positive because we've held it so long that we're now, we really don't have a lot of mortgage expenses. We've rehabbed it nicely. So in all honesty, we're almost cash flow positive every month. The thing that I ended up doing was I mentioned the rental land. I invested and we have solar panels that are on there now because those tax credits can go right on your property. I have a number of clients that actually put solar panels on the rental houses because you get tax deductions, you get tax credits, and you have the ability to really kind of expense a lot of expenses on short notice. Most solar panels can go in within 30 days of the time you talk to a solar company. So that's one great way to think about kind of lowering the overall cost of your investment, because now the expense for electricity goes lower if it's a short-term rental. And also you're getting a lot of deductions for yourself. Another thing to think about is, can I make any improvements? Is that, can I hold on to that washer one more year or can I just replace it now? That goes back to kind of what Danielle was mentioning earlier, which is that you kind of need to look on a personal side to see, hey, is it more beneficial for me to take expenses in the current year for maybe replacing some items, cleaning the carpets an extra time, changing out washer dryers, replacing refrigerators? Does the house need a new coat of paint? Normally you would paint it when a tenant leaves, but they're going to leave in 2 months anyway. Can you sneak that deduction in the current year? So a lot of times I like to tell my clients is there something that you would do within the first quarter of next year anyway that you can do today to take the deduction? But then you lose that deduction next year, right? And that's the hard part. And that's where good advisors tend to come in. That's where good real estate agents tend to come in. That's where good financial advisors tend to come in. Because if you know you're going to be selling that property the next year, well, just wait and take the deduction. Because in all honesty, the benefit you're going to get in a year of sale oftentimes exceeds the benefit you're going to get in your regular years.
Gotcha. All righty. Thank you for that. I want to go back a little bit, just kind of on a personal one. You were talking about you have some land and you were actively trying to rent it for solar panels, you said?
Yes.
Let's here where we are in Florida, we're in LA, Lower Alabama, and a lot of people here actually own property in Alabama that may or may not be hunted occasionally. I'm one of those people, and let's just say I say, you know what, I would like to do that so I can have a write-off with that property, even though people hunt on that land. If I actively search for somebody, what happens if nobody ever decides to do it?
Well, that's where the IRS basically gives you 3 years. You get 3 years to identify a real active business process. And if you can't make a profit within 3 years and show cash flow activity, they're actually going to reject not just the current year, but your prior years of deductions. So that's where it's really important to have a real business identification. And one of the things that often comes up is you'll see some practitioners get really aggressive on deductions. What they don't tell you is in the event you get audited, you could be hit with a 25% fraud penalty on top of the 5% per month penalty for underpayment of taxes.
It's
and
okay.
so
The person who rents it just sent me a text and said, don't scare my deer and turkeys away with your solar panels, lady. So I guess we're not doing that, but yeah.
Yeah, honestly, the thing that I advise a lot of my friends here, because most people, I live in Minnesota, and most people have either a cabin or a hunting ground that they go to in Minnesota or Wisconsin. I tell them build a homestead on it and get just a log cabin out there with an outhouse, and then rent that out during non-prime hunting season. You'd be surprised, myself included. I go and I rent people's cabin in the woods just to go for camping. I'd rather have a nice quiet place to go camping rather than going to a normal camping facility. So you'd be surprised, even if you can't get it for maybe what you want to use it for, sometimes you can find other uses of that property, like solar panels or camping expenditures, church retreats, things of that nature, where they might just want a nice open tract of land to be able to use for themselves.
So, and here's another question, because and this is a crazy one, and it's a little bit out of the real estate realm, if you will, but I get a lot of people that say, I have a camper and I own some land. What happens if I put the camper on the land and rent it out? Do the same rules apply as far as it being quote unquote a rental property?
That's where it depends. You need to look at the amount of the land. Is the rental property, is the building the actual rental property? So here's kind of the problem. You can't depreciate land under both US GAAP, generally accepted accounting principles, and US tax law. So what you're really trying to do is take the depreciation on the camper, and oftentimes just putting a $40,000 camper on a plot of land is not going to drive you the type of expenses to validate that kind of cash flow expense. At the same time, if it's one of those mixed use properties where you're using it, oftentimes and you're renting it out frequently, sometimes it's nice to be able to do that because you might be able to get to deduct some of that camper every year, a little bit each year to just offset your overall ownership of the property.
Okay, I mean, I'm just seeing that a lot more here, where people are buying
Yeah.
campers and putting them on land and renting them out. Okay, so what's our next one, Danielle?
We are just
We're done.
yeah, questions and answers. So if anybody has questions of their own that they would like to discuss, you can either take yourself off mute or pop that into the chat. I know that we had a few already. And I'll just kind of recap what I've learned from the seminar. One, I don't have a good bookkeeper, and YouTube chatting is kind of like, oh, wow, if I go to sell my house in 10 years, like I did a full remodel and a bathroom remodel, a kitchen remodel, I redid the basement. Where are all those records so that I can identify what my cost basis is in the future is super important. So not only to help me offset taxes now, but in the future. And then the other thing that I'm super excited about is going to buy an investment property in Florida or Hawaii or somewhere, just making sure that a lot of that time is spent on investment property searching. And then I can write that off as I look for a new place to invest in, as well as looking at my current tax bracket and what I think it's going to be next year to offset that, and possibly looking into becoming more of an active income or more short-term rentals where it's active income for high income earners, W-2 earners, that those deductions can offset a lot of your higher income W-2 earners. So those were kind of my takeaways. Sue, do you have?
Mine was what you said about the traveling to find a property. That was huge for me. The bookkeeping, obviously, Venmo is not a really good bookkeeper probably, which is kind of where I am right now. So yeah, I think I learned a lot about that. And then trying to figure out how I can sell all of my properties and just buy a yacht is kind of my big takeaway. There's that.
I was right there with you, Sue. I'm like, how do I get a $4 million house so I can go get a
You don't
$6 million
understand.
yacht?
My son who works with me is all the time sending me boats. Look at this one, Mom. Look at this one. I was like, oh God. So I know a lot of the people on this call are real estate agents, and I am quite sure that you guys get asked a million questions by your clients. So please unmute yourself. Ask us if you have any that you feel like your clients are asking you that Mike could certainly. I mean, it's free at this point to get an actual accountant and CPA all in one to tell you an answer to a question that a lot of clients are asking. So please feel free to ask questions that they're asking you. If you don't have any questions, you can see the name of the company here, Salt Marsh, Cleveland and Gunn. Do we have y'all's phone number? What is your, Nancy, can you unmute yourself? Are you there? Or Jamie? Hi. If people want to give you guys a call, are there any states that you guys don't do taxes in?
So we do taxes in pretty much any state.
Okay. So I mean, because there's people here from all over the country. So if anybody needed to contact somebody to have you guys take care of them, what would your answer be?
So actually, we will be sending you guys all a follow-up email tomorrow with the recording and also Mike's contact number and also just our normal tax department's contact information, so that you guys can learn more about us, and also rewatch Mike's presentation with Sue, because there's a lot of good tips in there, and you guys just check your emails tomorrow and you get all that information.
All right, and one more thing I do want to mention while we were on this call, Mike, while you were talking about the quick bookkeeping piece, Jamie Terrell, who is in your marketing department and I know very well, I messaged with her and she said that you guys have a bookkeeping department as well as the accounting part. Is that right?
Yes.
So,
Yes, that's right.
Danielle, we need to be the first ones making those phone calls. So
I know.
if anybody on this call needs a bookkeeper, they do offer those services as well. And on top of that, they obviously know all the deductions that you should take. So that's a great thing. Somebody just put in a question. Is it more advantageous to buy investment property in cash or take a loan? Before you answer that, Mike, I'm going to answer it from the mortgage side. this is what I'm telling my clients these days. If you need a deduction on your taxes, as many of us do, because we get taxed a lot, I feel personally, and it's not just because I do it, I think taking a loan is your best option. If you can make it cash flow, like Danielle mentioned at the beginning, you get the investment write-off of the interest. I think that's more advantageous, but that's just me and I do loans. So Mike, what's your take on that?
So for me, it goes back to, does it cash flow? If you can cash flow it with the mortgage, I have a number of people that have sold their primary house and they went and they used that money to go buy 2 investment properties at a 60 to 80% loan to mortgage value, right? So basically what they did was they took their open and available cash flow and said, rather than paying for 1 house in cash, I can buy 2 properties using, you know, a 70% mortgage on those each property. And by doing that, they maybe aren't making as much cash flow each year, but what they are doing is they're getting additional deductions and they're setting themselves up for long-term appreciation, especially as that mortgage starts to kind of wind down or you can refi it to a smaller rate, you know, oftentimes years down the road. When that happens, those become very cash flow positive and becomes not just a cash flow mechanism, but also a trust and estate planning mechanism. Because if you have a rental property that you've had with a mortgage on it that has payments, things of that nature, if you go to gift that to a child or a relative, oftentimes the value of that mortgage reduces the value of the gift. And so it can really become a really interesting trust and estate planning mechanism when you start thinking about, oh, I can pay cash for this building. Oftentimes it's actually better to go, wait a minute, what do I really want to do? Do I want to go buy 2 buildings, or do I want to, you know, take out a loan and then gift this building to somebody else at only 70% of the value, knowing that's already cash flow positive? Right. You know, these are kind of some tips and tricks that a really good accountant or a really good attorney can walk you through. And oftentimes, one of the big mistakes I see is that my clients don't call me for phone calls, either you know, around tax time, or, you know, I typically reach out to my clients once a quarter just to check in, see how they're doing. You know, some clients I speak with every day. But, you know, the ones that are kind of, you know, just personal taxes, I tend to just shoot them a quick email. They don't take me up on that. And what they miss out on are conversations like this of, oh, I'm thinking of buying another house. What can I do about it? Because if you have a good relationship with your accountant, they'll be able to say, oh, well, you're also thinking about making a gift to your niece, or you're thinking about retiring in 5 years. And they're able to give you not just guidance on what the tax implication is, but what your life implication is. Because at the end of the day, all of these investments are about the heartbeat. They're about the people on the tax return. They're about the people that have to pay the mortgage. They're about the people that are going to be left with the mortgage if you should pass on. And taking care of the heartbeats are really what kind of the mortgage industry, the accounting industry, and professional services are kind of all about.
Absolutely. One of the questions was about adding back the depreciation. On the mortgage side, when we do calculation of income for somebody who has a rental property, yes, we add back the depreciation. So I've actually had people that said, well, I didn't write off as much last year on my Schedule E because I wanted to get a mortgage this year. Don't let that stop you. Write it all off because we can add it back. So that's a good thing that we are able to do. We don't hit you for that depreciation expense you took. Does anybody else have any more questions?
Another piece to that, Sue, a question from my side on the mortgage as well. On the depreciation deductions that we're talking about for the 2 years of the tax, we would do an average on the depreciation, correct? For 2 years to add back in as income, we use 100% of that. But if they actually made money and had a depreciation schedule, would that fall under the Schedule C? And then we would do an average of the 24 months if they made an income on the property for income to go buy another piece of real estate?
The income, the way we do it is we take it all from the Schedule E, whatever your income is, your loss. And I'm going to tell you, most people on rental properties on tax on paper show a loss, and that's not a bad thing. So don't say, oh my God, that's horrible. It's a great thing. We add back so much just from that. I don't average it for 2 years. I just use the most recent year just because the way rent's going up is kind of like the way houses are appreciating. So I just use the most recent year. I add everything back and divide it by 12. And yes, if they had income and I add back the depreciation, they have more income. Does that make sense? So, I mean, I use the schedule we have in our system for rental income, and it adds it back, and it's a good thing. But yeah, you always want to try to make it show a paper loss, in my opinion. It's kind of funny because I'll have people that'll call me and they're like, yeah, I made, you know, $75,000 on my rental properties last year, and I get their tax returns and it shows negative 37,000 on their rental properties. But that's not a bad thing. So
Yeah, and one of the other things I want to just make mention of, and I'm not sure if Waterstone does these types of mortgages, but I can't tell you how many clients I have that go in on it together, where there will be multiple family members that will create an LLC, and they'll go buy a second home together that they use as part vacation rental and part vacation and part rental. And oftentimes that can just be a great family investment if you have really good relations with your family. It can be a terrible investment if you have not great relationships with your family.
yeah, believe me, I'm learning that right now. You have no idea. So yeah, somebody who's selling Florida or selling property in Florida currently and buying in Colorado, Danielle is a great resource for that. She does financing in Colorado. You sell the property. She has great resources. We all have great resources for 1031 people. Just to let you know, and I think we talked about this the other day, Mike, you guys aren't licensed intermediaries for 1031s, correct?
Right, we can't act as a straw man, but oftentimes we do what's referred to as the doc exchange, where
Right.
we'll do the entire setup of the structure, and we'll do the tax implications and do all the calcs to provide to the qualified intermediary.
Okay. Anybody else have any other questions? Okay, so now here's my next question. If you could, in the chat box, put in something that you learned today or something that you would like to learn in the future, because Danielle and I love doing these and bringing you value to help not just the real estate community, but also their clients. So tell us what you did learn. If you learned something that you think is very valuable, what you would like to learn in the future, and tell Mike what a great job he did, because it was amazing. Thank you so much, Mike. We truly, truly appreciate it.
Yeah, great
Thank you
job,
so much
Mike.
for having me. I really appreciate being here.
But we'd love to have everybody, if you have any questions at all, reach out to Danielle, myself, Mike, or Nancy, or Jamie. And yeah, that's the big one. Keep good documentation of your research trips. I love that. Minus the yacht. Me and Brent are going to go in on a yacht, apparently. So.
You know it.
Anyway,
I got plenty of water over here too.
You got what?
Plenty
know
of water
what?
over here,
I got prettier water over here.
right?
You're on the wrong side. Tell him, Nancy.
Yeah, you can bring your yacht over here if you would like.
We just sold